Hey everybody, we're live here with the Holy Macro Show. What's up, guys in the chat? Paris, we got Mark, DP. So thank you guys for joining us. Mark actually helped with the name for the show. Actually, I always forget that. I always forget to mention that. I was asking people like what we should name it because Kashop and I'd get on, and one day I'd call it something, the next day I'd call it something else because I have severe ADHD, so I'd be all over the place every single week. And then finally, I was like, "Will you guys give me a name for the show?" And we came up with a bunch of them, trying to talk about it. Then Mark was like, "Holy Macro," and I was like, "Actually, that works well." So here we are with the Holy Macro Show today. It's Friday. It's a beautiful day in the Midwest. I'm just kidding. It never has been. It probably won't be until next year at some point in April. But it's a lot of snow with a lot of pressure changes. It went from like I was in Baltimore. I got home. It was negative temperatures outside, which was miserable. And then 2 days later, it was like 45 degrees. And I was like, "Hey, we're getting this reprieve. Maybe this will go on for a little bit." The next day, it's snowing again. Everything's frozen. So if you go outside, like everything that was just getting rained on because it was 40-some degrees, now it's all frozen. So have fun with that if you're in the Midwest. It's a great place to live. Just kidding. But anyways, nobody from the Midwest. You know, it's funny. Nobody from the Midwest is like the Midwest is great, but we live here, so we must like it for some reason. Or maybe we're just all masochists. I'm not sure just yet. So, Kashop, going through your week, what have you been seeing out there that's sticking out to you that people should be paying attention to in the markets?
Gold. It is so strong. Like you would have expected a little bit of a correction, but no. And silver is just screaming higher, is going parabolic. And the funny thing is, if you look at what the commodity people are saying, so they are saying that silver screaming higher like this is a sign of a top. That the last time silver went parabolic, the move topped out, and so it's going to happen again. So I don't know if that's true. That's not my reading. So I'm going to put the question over to you. Do you see this as a Hunt Brothers 2011 kind of situation, or do you see this as something completely different?
Everybody likes to say that, if we think about it, like sometimes silver just tops earlier than gold, which is usually the tell that the rally is over. So, if we start to see silver really top, and I'm not talking about a pullback every single damn time. I mean, I get so many, it's almost frustrating and a little bit annoying to get so many damn emails. Not even annoying for me. I don't mind the questions. It's annoying that, like, people who've been trading for a little bit, once you're trading a little bit longer, like not everything's a top. But when you first start trading, everything's a top. And I had that problem too. I'm not blaming anybody. I was the same way where I was like, I got to short everything. Oh my God, it's moved up a lot. I better short this thing, whatever it is. The harder thing to do is to really just identify the trend and stay long. And that's really tough for people. And that's something that like you master over time. It doesn't happen overnight. So really, to me, I'm gonna say, hey, continue to look at the relative trends. If you saw a situation like if the bull market didn't look, I mean, I literally brought this chart. I think it's at the end of the deck, so you guys are gonna have to go through this whole journey with me. I'm gonna show you guys everything. But if you literally see a bull market that looks like this, which at the top of this list, if you can't see it, it's silver up 103%, platinum up 87%, palladium up 68%. Now, I took this screenshot days ago. So actually, platinum's up over 100% now. Silver's up over 110% currently. But I want to show the structure of this, which is silver, then platinum, then palladium, then gold. Basically saying, this is the most risk-on precious metals I have seen in many years. We have just seen, and Kashop and I have talked about it a ton, which is if we're looking at gold miners, silver, most of the time it was gold leading the way. The outperformance was all in gold the last couple of years. This year is different. Gold is the underperformer, and silver is doubling its performance. That is insane. So thinking about it, think about shorting it would actually be fucking insane. Let's be honest. Like that would be absolutely out of my mind. But people are going to do it, and somebody will be right at some point. Somebody will be right at some point. If you short a thing through the whole uptrend. Shop and I used to know a guy. He was always short, so therefore he's caught every single bear market in history. Yes, if you're always short, you will catch every single bear market. If you bought put options when silver was $30 and you keep putting on put options at silver at 65, 70, let's say 100, at some point you're going to be right. but you're going to lose everything till you get there. So why not just ride the trend, shut up, take the trend, stay long, and don't think about it more than that. It's easy to overthink it and go, well, silver did this. Silver topped the last time it was at 50, therefore it's going to top every time at 50. You could talk yourself out of every single good trade if you want to. I used to do that myself. I would suggest not doing it. It's a very bad habit to get into. But here I'm looking at the precious metals bull market. It's it's together. Like, that's intact. That is about as good of a structural move for precious metals as you're ever going to see in your lifetime.
And it's also important to distinguish the other bull market tops from the current one, right? So if you look at it on the fundamental side, 1980s, why did silver and gold top out? Well, so go back to the, I think it was Business Week. They had a cover saying the death of equities. And that cover is famous. But what was the story inside that magazine? The story was pension funds are now broadening their mandate to invest in diamonds and precious metals. Why? Because with equities, they cannot make their defined benefit payouts. So that was the headline. So when you see a headline, then that, yeah. And then the Hunt brothers, who had done a very successful corner on soybeans earlier in the decade, got so cocky that they tried it again with the silver market, and the exchange changed the rules. Now there was a precedent to that. So you look at that and you see the silver top there, and you look at, let's say, even 2011, the way the commodities moved from 2009 to 2011. So it was three straight up years. And that was all happening while the Eurozone was in crisis, when the US was sort of starting to recover. So you had a uh, commodities moving in a recessionary environment. Now, a move like that, how long can that sustain? Well, that's a different question. Whereas now, if you look at why commodities are moving, well, they are moving because the Fed is printing money. It is as simple as that. They are moving because they haven't had a real bull market since the 2011 top. So, gold had a brief run from the COVID lows until I think it was August of 2020, and then it was done. Then it was crypto. And now what are you seeing? You're seeing the rotation out of crypto and into the hard assets. So a move like this, it can last a long time. The fundamental supported, the technical supported, the trend supported. So what are you really doing by thinking of fading this bull market? I mean, you might say, oh, I hate silver, so I'm just going to go invest in crude oil, let's say. Yeah, okay, that's your opinion. And if that's the way you want to trade, then good. There are many ways to make money in the market, and that's yours. But if you're just neutral and you don't really love or hate assets, when you don't have emotions attached to one particular asset, what do you take? Well, you take the best trade. And what are the best trades right now? They are all in the precious metals. So you take them. It's really as simple as that. So why would you keep second guessing the best trade, the one that's working, the one that has all the catalysts to keep working? So I think that should be the real question, not whether, hey, this thing is going parabolic. Last time it went parabolic, it topped out. No, that's the wrong way to look at it.
Yes, exactly. So if we look at that, I think here's the thing that everybody wants as a trader. Every person who's a trader wants the new gold, the new silver. They're like, okay, well, silver has made its move. I can't possibly invest in it today. So therefore, I need to go to, let's say, energy, which is massively lagging, very frustrating. So why wouldn't you get into something like silver then? Like, I can take some energy trades because it really doesn't matter to the portfolio. Like, it's like, okay, we have these great silver trades. I'm going to stay in these silver miners, copper miners, gold miners, whatever. I'm going to stay in these futures contracts, which are gold, palladium, platinum, silver. They're all making money. So it doesn't matter to me when the next trade I put on might be like something like energy and I can sit in that for a while. But it's the same way this worked. It's not like I came in and was like, okay, gold, I know it's going to be at 4,000. It's going to be the craziest run in gold ever. I better buy gold miners, silver miners, and so on. No, it was the same way I'm doing energy today. I might buy some leaders. If I see back then it was gold was leading the way, and that was about it. So you bought gold. And then you bought some of the major miners. I think it was AEM was the first one in the portfolio, and a couple other ones went in the portfolio later, the ETFs and so on. And so that's how you ride these cycles. Same with energy. It's like it's okay to nibble on a couple things. There's a couple things that are making a new high. There's a couple things that are showing relative strength. Maybe the fundamentals are good. Whatever it is that, however you trade, fine. But it's not the time to just go heavily into something because this other thing over here has done so well. Because I keep hearing that, Kashop, which is money has to start flowing into oil with silver up here. And one of the reasons I keep getting for that actually is, I'll bring it up. Now you guys are going to get the whole deck in reverse. So looking at the oil parity to silver, hasn't happened since 1980. So now it's obviously, this is the time, Kashop, that oil has to go up because the parity. Like, it's like I could make a million of these charts and tell you a billion reasons why something should or shouldn't happen. The problem is, at the end of the day, that nobody fucking knows. Like, it's like that thing in The Wolf of Wall Street where he's saying, like, nobody, I don't care if it's Warren Buffett or Jimmy fucking Buffett, like, nobody knows where the market's going to end up. And really, that's true. Like, nobody knows how far this dislocation could happen. Could silver get to 100 and oil be at 60? It's possible. It can happen. So once again, you don't want to front run those moves, not because it can't happen. Like, I fully believe energy at some point is going to move. It's going to be another big trend, but I still think that you don't sell your winners for your losers. Something that actually I was talking about today with Sam, which is, we're talking about that, like the Paul Tudor Jones quote, only losers average losers. Like, what he means by that is that, like, let's say I'm going to go, hey, I'm going to sell my, like, and you could have done that. Like, nobody would have done this today. Everybody talks about how they would do it right now. It's like most people who'd be in the silver trade today have been hanging on or running some sort of system or have a firm belief in it. So they've been in it for a long time. But if you were just trading it and you traded in a way that made you jump from asset class to asset class, you'd have sold all your precious metals, earlier this year. You would have made, let's say, 40%, 50% of the move, been really happy about that, started moving into energy. Then the rest of the precious metals market moves another 100%, and you would have been sitting in energy doing nothing. So you always have to keep that in mind as a trader, which is like, keep riding your winners, let them run. I always say you never know where your biggest winners will come from. This is one of the most important things that I think I say all the time, which is, when you don't know where your biggest winners will come from, you have that ability then to step back and go, well, why am I going to get into energy today? Why am I going to sell all my, like, not even saying energy is bad, but why am I going to sell all of my stocks that are doing very well in the precious metal sector and these mining stocks to buy something like energy? I'm going to be disciplined. I'm going to hang on to these things that are really working. And with the extra capital I have, maybe I'll deploy it into a couple new areas that I think make sense. And so it's the same thing. Now we're looking at energy and going, okay, I'll take these strong ones. And then maybe when oil moves, I'll get a little bit more bullish and talk about that more. Maybe XLE actually breaks out for once or makes a new 52-week high. That would be another reason to start getting more long energy. But I would never, no matter what the situation is, sell my winners to then buy the energy stocks that are lagging. That doesn't make any sense. It's the reason why I hate when people use the term catch-up trade or sympathy trade, because what that usually means for people isn't the fact that it's going to move. It's the fact that they should be selling out of these winners to pick up these losers, is what they're usually talking about. And most of the time, losers keep on losing, and that's the truth.
So there are two styles, right? One is the trend trader, and the other is the mean reversion trader. So a lot of people, I think, when they start trading, like this was true for me as well. So I used to do that. I used to say, okay, this has done a lot, this has done less, which means that it should revert. Like the market just always mean reverting. But that is simply not true, because if you look at long term charts, you see clear trends. There are very, very few examples where you just see sideways chop for years and years. For instance, if you take the wood ETF, that has gone nowhere for years. So there are very, very few exceptions like that. But mostly when you look at a market, it's trending. It might be a messy trend, but it is trending. So you do look at a long-term chart, it's an uptrend or a downtrend. Now, if you keep betting on a mean reversion within an uptrend or a downtrend, yes, it will happen. But is that really the best way to capture that market, by betting on the mean reversion? Not really. You could have mean reversion on a shorter time frame, but when you look at a trending market and say, hey, I'm going to bet on mean reversion, you are going to get screwed. That's just what's going to happen. And believe me, I have done this enough times that I know this, because I love taking that mean reversion trade. I love saying, hey, this is the top, this is the bottom. I'm going to short this here, I'm going to buy this here. And I mean, that is pretty much what buying value was. And I used to be a value investor. So I used to do this all the time on the long side. So I know it just doesn't work. The best way to do it is to have some sort of system that gets long the trend and doesn't second guess it. And for exits, again, you have different systems. So you can use an ATR stop. If you think silver has gone parabolic, for instance, and you want to have an exit where you don't give up too much of your gains, use a parabolic stop and reverse. There are enough ways to do it, but the point is to pick the winning strategy. And in a trending market, the winning strategy is to get long the trend. In a sideways market, or if you're just trying to control the volatility in your portfolio and you want to do some mean reversion, sure, go for it. But that should never be your primary goal. Your primary goal should always be going with the trend.
Yes, and making those big returns. Like you can't make those big returns if you're looking for mean reversion setups. That's the reason why we think about it like 5-to-1 risk to reward. Meaning, if you have $100,000 portfolio, make it an easy number. You lose $1,000 on your losing trades. You make $5,000 on your winning trades. This means you only have to be right about 20% of the time to make money, and most likely you're going to be right more than that. So if you set it up like that and you're looking for these big winners and you're trying to ride these trends, like you're going to make a lot more money than the person who's just out there second guessing themselves, second guessing their system, their strategy, and trying to buy laggards all the time. People always say that, and bull market technicians say this all the time. In a bull market, everything will go up at some point. That is complete bullshit. I fucking hate that phrase. I'm gonna say it as profanely as I can because it drives me crazy. Because it's not true. It's complete bullshit. It's like saying like, oh yeah, in a very inflationary cycle and where everything's moving up, at some point REITs will do great. That's bullshit. They don't. They're very tied to interest rates. That would make a lot more sense. Or it's like saying healthcare, like everybody's all of a sudden interested in healthcare because biotechs are going up and they start to think healthcare should go up with it. That's bullshit as well. Biotechs are unprofitable, basically the worst stocks in the world, and just a lot of speculation. So a lot of times you see that in a very risk on environment is when biotechs move up. And then a risk off environment is when healthcare stocks move up. So basically, you're looking at anywhere from I think it was 2019, healthcare did decently. So you're basically looking at bond yields to move down in the long end of the curve. You're looking at growth rates to be moving down across the board. You're even looking at a little bit of deflation happening out there. If you have all that together, you're going, okay, healthcare should do well. Where are we at right now in the cycle? Well, global growth rates are decent. U.S. not as much, but global growth rates look great. And then if we look at yields are moving up, and inflation is sticky as hell, and everybody knows that. And globally, yields keep making new highs. Why in the hell would you want to own healthcare when you could own things that are high beta that are going to make you a lot more money? So that's the way you want to think about these things instead of like going to these laggards and continue to buy the laggards, buy the leaders. I mean, here's the thing. I always think about this, Kashab. I always tell people when they first start trading, if they could do one thing differently, just one thing, I would always say those big trends that scare the shit out of you when you feel like they're parabolic and stuff, but you kind of like that sector and you think you need to buy it, buy it. And those things where you're like, oh my God, it's super cheap. This isn't a downtrend. I can't believe I'm going to get like, let's say this Nvidia stock, let's say Nvidia stock falls 50%. I can't believe I'm going to get Nvidia for a 50% discount. Don't buy it. And if you could do that one thing, you're going to make a ton of money. If you can make that one switch, just one switch in your trading, not a ton, just one switch, that will make you so much money as a trader. But nobody wants to do that. And it takes a while to be able to do that. I'm not saying like you can't do it other ways, but I'm saying if you're new to trading and you want to figure out a way to do this well, get used to buying things that you don't want to buy and get used to selling things that you don't want to sell.
Yeah, I think that sums it up perfectly. So what are we looking at here? This is crude oil versus the 30-year yield. What are you seeing here? The divergence.
So when we're looking at this one, so there's two things. So there's two charts I have today, which is this one and then copper. It's a 30-year yield. So when we're looking at the 30-year yield, what we're seeing here is most of the time the 30-year yield is pretty in tune with oil or at least catches up to oil, or oil catches up to it, and so on. So as you're seeing through that 2020, 21, 22 period, you're seeing like these are kind of moving together. Oil hits that bottom, basically rates hit all-time lows at that point, or at least multi-decade lows, and then or century lows really. And so basically we hit those lows in 2020. So first off, it was the 30-year yield, which hit it in March, and then crude oil hit the low in April right afterwards. And then they both started to move up, and so then they're starting to chop around, but they're chopping around higher. So as they're chopping around higher, we get this massive move in energy, crude oil, basically any commodity under the sun that you could throw a dart at. Then we start moving the other direction. Now we're in a downtrend for oil. So now we're in a downtrend for oil, but what are we seeing here as well? Well, even though the 30-year yield isn't hitting new highs, it's still making higher highs and higher lows throughout this part of the cycle. So we're seeing this was the highest high. We haven't hit that yet, but look at higher low. And then we're making it high here, then higher low. Then we make another high here, higher low, new high here, higher low. Let's see where this one ends up. But mainly what I'm looking at on this chart is the divergence and saying that crude oil hasn't caught up to it yet. So I don't know exactly what that means. That's a mixed signal. But if we go look at the next one, we look at copper. I'm looking at the fact that copper also tracks the 30-year yield very closely, just like oil, which it should. Makes sense. It's based on global growth and global inflation rates. So now copper is hitting some new highs. It's all-time monthly closing highs that we've been hitting in copper for a little bit now for the last month or two. And so as we're all the way up here, I'm thinking a little bit differently and going, okay, well, this one is kind of telling me that yields are still moving higher. And then if we look at global yields, which is what nobody wants to look at because nobody looks at the bond market, let's be honest. But if you look at global yields, you look at German yields, they're hitting new, what are they, multi-decade highs? You look at Japan, it's hitting new highs. You look at Great Britain, they're hitting new highs. So all of these bond markets are hitting new highs on the long end, even though they're cutting rates on the short end, which is telling me that I think we're in the scenario here that, you know, our yields in the United States are going to move higher. I don't know when oil will do it, when oil will reverse. Everybody wants to know when oil will reverse. I have no idea. But what I can say is that I don't see an environment where the U.S. 30-year yield starts hitting new highs and then oil is hitting 52-week lows. I think that's insane to think about. I think the scenario here is that oil is in a rough period fundamentally, but that doesn't last forever. Like everybody goes, well, you know, they look at the numbers and go, well, supply this, demand this, and so on. That's great and a good way of looking at things, but you also will never know when things change if you only look at that. You have to look at the price. So for me, getting crude oil to a 52-week high is going to be very significant, meaning that's all the way up. I think it's 77, around 77.50. So if we start to get up to near those zones, I'm going to get very interested in energy and probably buying everything energy under the sun at that point, because I would assume at that time XLE is hitting, you know, new highs, maybe new all-time highs, which is very possible. It's only up at, it was 101. They cut it in half, so it's probably 50-50 now. So we can hit those all-time highs in crude oil, or sorry, in XLE at that point. We can start looking at a lot of these stocks that are already starting to do well to do even better at that point. And even with the big pullback in energy and oil, I think it was last week into this week, you're not seeing like an insane structural breakdown in the energy markets. Like any of the energy stocks, they look fine. It looks like failed. They tried to make a top. They didn't make a top. They continue to move higher. They're consolidating right near the old highs, few percent around those zones. I really think this is the time we want to still stay bullish on energy. Doesn't mean buying it. I'm just saying put it on the radar, take buy signals when they come in. But right now, I'm not too bullish on it. I don't want to get too crazy about it. I also don't want to get too crazy about like speculating where oil is going to end up. I want to see it close up here today. Like if it can close this week at a level that's not at a 52-week low, I'd be more bullish on it. And then if we can kind of get to that new $77 range, I think it's buy everything energy at that point. But we have to be patient on it. And then looking at all these, we're looking at the same thing. We're looking at energy consolidating near the highs. This was taken a couple days ago, so this is actually back up here now. So it's actually not quite at a breakdown. It's not going to close at a breakdown this week. But oil was breaking down. Maybe it could make a false breakdown signal. So if we get above 58 today, that's a front month contract. We could say, okay, that's a false breakdown signal. For people who take those, you can take one of those signals. Gasoline hit a new low, but heating oil, on the other hand, still looks very interesting. So most of the time, you see heating oil really leads the way down. And I'm very surprised in how good heating oil has held up. So there's some reasons to be constructive. I don't want to say bullish. I said bullish earlier. That's probably not the right word. Constructive on the energy sector. But what do you think about the energy stocks currently, Kashap?
So I have just one in my portfolio, and I think it's giving me great dividends. So that's a plus, and the price action hasn't been terrible, so that's another plus. So I just have it as a bottom fish while I wait for some catalyst to play out. And speaking of energy, so energy is a broad term, so it's a lot more than just oil. So if you look at XLE, for instance, the reason these stocks are holding up well is these are the big producers. They have hedges, they have exposure to other things besides just oil production. So when you have a diversified energy play, they are less responsive to prices in the to changes in the oil price. Whereas if you go to XOP or a direct producer or a high cost producer, let's say in Canada, then you have a different proposition. So I think when we talk about energy, people need to make that distinction as to what we are really talking about. So when we are talking crude oil, then yes, it's not really a great time to be into the oil producers, although you could start to look at them as a good bottom fish right now. If you're talking about the broader energy space, then that looks very constructive. So I agree with you on that. But having said that, the trade right now is to be long the precious metals. For me, it's to be long a couple of other sectors which are not correlated to precious metals, and then a little bit of energy. So the little bit of energy will grow into a bigger allocation once the price action makes sense. That is, once the price action becomes a little more bullish. So I'm waiting for that. I'm not going to front run it because all the trades that I have are working. So why would I want to uh, get into something and then get stuck? Oh my, why this is not working? It's the holidays. Let me just enjoy my time and then figure it out next year. So that's what I'm doing. But that said, if we get a massive breakdown, then you should definitely be setting buy alerts and building your watch list.
Yes. And so Free Lee had a question here, a couple of them, which are good. Let's bring those up if I can figure that out. Okay, there we go. Oh, wrong one. Oh, we can start with this one. This is a good one. What would you recommend as best couple books for futures trading? Thanks and happy holidays. And happy holidays to all you guys. Thanks for saying that, everybody. So for me, futures books, man, that's a funny one. So it's when I first started trading futures, I read all of the futures books on how to figure out how to trade futures, the structure of it, the contract sizes, the leverage, all this stuff. Um, you can do that just like I did. I would suggest trading it maybe with a paper account. I did not do that, but trading it with a paper account to just learn how they work. Put on the trades in a futures account, see what's going on. There's future specific brokerages. I can't remember the names currently, but if you look at a future specific brokerage and you get a paper account and you just start messing with it, you'll understand the leverage. You'll understand how to trade it. Like you'll understand how the margin works and so on. And I think that's much better than trying to say, hey, read this book. This one's going to be great. It's mainly like it's like options. Like you can't really understand how to trade options without really trading options. Paper really doesn't help a ton, but at the same time, it might just help you to understand the sizing, the positions, how volatile it can be, and so on. So I think that's good. But really, to me, it's like read Reminiscences of a Stock Operator. If you haven't, it's a great book, one of my favorites. I talk about it all the time. And then Market Wizards. Market Wizards 1 has a lot of futures in it. It's amazing, great futures book. Talks about the futures, checks about the futures markets, how they trade it, and so on. One of my favorites of all time. Two easy reads, a lot funner reads than digging in and trying to just read about what contract sizes are. Jack Schwager has a book on futures, which is actually pretty fun, but it's pretty outdated at this point. So that's another one that you could check out. But really, it's a read the actual books from the actual traders who traded these things or the interviews with them. And once you kind of figure that out, you can get an understanding of how you would trade these futures market, what type of strategy you want to run, and so on.
So I would say all the books Jason said, and then I would add one more, which is Hot Commodities by Jim Rogers.
Oh yeah, good one.
And
Good one.
yeah, it's almost 20 years old, but you read it, it's still very, very relevant. And this was written during the book Hot Commodities. It was written during a major bull market in commodities. So when you look at the way he's written it, and when you look at how the commodity markets are now, it's like those 20 years don't exist. It's like it's written for this market. So that's why I would recommend it. And the other book I would recommend is Technical Analysis Explained by Martin Pring. The reason for that is if you go into the commodities markets or the futures markets thinking you're going to trade them off the fundamentals, you are going to get killed. You're going to blow up for certain. And the reason is sometimes markets move in irrational ways. And I would put irrational in quotes because what appears irrational from a fundamentals perspective makes perfect sense from a positioning perspective. So the commodity market, the reason people use it, the reason is not, that you put in a $5,000 margin and you make $50,000. That's not the reason people use it. Mostly people use it. The people who use it are the commercials. They are there for hedging. They are there for getting some value out of it, some risk that they want to offload onto the speculators, that is people like you and me. So the way they do things, the way they think about it is not the way we think about it. But whatever they do, it shows up in the price action. And the best way to read the price action is through technical analysis. And yes, your COT reports, all of that, you can add that in later. But if you read a good technical analysis book, it will tell you exactly the right way to approach the futures markets. Now, from that, you build your system, and your fundamentals are, of course, going to help you figure out what markets, figure out how loose you need to be with your stops, how confident you need to be with your position sizes and things like that. But if you don't have both, you're going to get killed. So as much as I'm a fundamentals guy, you've seen me, you guys who are on the show a lot, you've seen me talking about the fundamentals all the time. But when it comes to futures, it's strictly technicals, because sometimes you'll not even know what is wrong, and then you're going to get really destroyed. And the key is you should not let the profits from 9 good trades just evaporate on one bad trade. And for that, you need technical analysis.
Yes, absolutely. Well said. And so here's Free Lee's comment. So is there a scenario where crude doesn't move, but everything else goes? Maybe like the supply stays high, so crude doesn't move. Crude doesn't move. Um, so a lot of people have thought like, that it's kind of the way the cycle works, right? Everybody thinks that oil's never going to go. That's been the thing the whole time. Oil's never going to go. Gold went, copper went, lithium miners, uranium miners, aluminum stocks, steel stocks. Everything under the sun is moving, right? And people are like, well, what about energy? Energy is usually the last part of the cycle for many reasons. One of the ones I speculate on when I think about it is okay, if I'm buying these energy stocks, let's say, and I'm waiting for energy to move, and I'm going, okay, gold has moved, copper's moved, and so on. How are they getting all this stuff out of the ground in the first place? Is it solar powered? Is it robots that are running off of the sun or something? Like, no, it's still using oil to get these things out of the ground. So there's still that scenario, which is why it usually turns into all of a sudden everybody's looking for gold, right? Gold's expensive. Why wouldn't they? All of a sudden everybody's probably looking for silver. Why wouldn't they? Silver's expensive. And then as you continue to bring more and more things online to look for these things, you usually see oil start to make a move at some point. Um, do I think there's a scenario where, like, let's say energy stocks move and crude oil doesn't? Because this question has come up. It's not exactly what you asked, Freely, but this question has come up a bunch of times, which is, can energy stocks keep going higher with crude oil going down? I don't think so. Crude oil would at least have to be stable, range bound, something for that to happen or be possible, not in a downtrend. Because also, like, this is how you value commodities to countries. You go, or companies, sorry, not countries. If you look at a commodity like oil and you say, okay, well, I'm looking at this energy stock, and let's say, you look at it and you go, okay, this company is profitable at when oil is $50 a barrel, and at $60, maybe they're still very, very profitable. Okay, great. But then if we talk about, okay, they're profitable at $50 a barrel, but they're going to be extremely profitable at $100 a barrel. That's really going to help the energy stocks move. So most of the time when you're looking at the underlying commodity, there's a very high correlation to whatever asset is actually looking for that commodity or whatever company is. So I do think that the scenario here is probably we need to see oil bottom out and move higher, and then we'll get very bullish on the energy space. But once again, like we said earlier, don't just buy the energy space because it should move next. Buy it when it starts actually moving. And so, Kashop, there's still a bunch of stuff to get through. Hop through a couple of these, but platinum is one that's just blowing my mind. We've had this position for a while, seeing this massive move in platinum all of a sudden. We're up 103%. I think it's up even more currently. What's your thoughts on platinum, palladium, platinum miners, anything like that? Any trades that you guys are putting on at your service? Something that people should put on their radar currently.
So I did have a platinum palladium trade earlier in the year, and I closed it too prematurely. The reason for that is I just wanted to free up space in the portfolio for other things, and that was just my own, you can say, mistake, or you can just say my positioning. But generally, when I'm looking at platinum, it is a very, very tough market to call. So what I would suggest is just going with the Aberdeen platinum and palladium ETFs itself, because the miners, it is really, really tough because you're taking exposure to South Africa, and there's really just one good name that you can buy, which is SBSW, which is Sibanye Stillwater. So other than that, you don't have much options. And I like to really dig into a space, see all the options. So I'm not invested in platinum right now or palladium for the same reason. But I do have rare earths and I do have silver exposure. So I have the other stuff. And if something great comes my way, then yes, I'm going to be looking at it.
Yeah, there's a lot of things. Somebody asked this one because you brought up the Martin Pring thing. Any thoughts on commodities to bond ratio by Martin Pring? Now, once again, Martin Pring is great. So we talked about somebody brought up earlier. Have you read Intermarket Analysis by John Murphy? Great book. Love that one. Martin Pring has great stuff too. But once again, it's a continue to the commodity to bond ratio actually is one that I use as well. Probably got it from Martin Pring, to be honest. But that's still holding up really well in comparison. Like bonds look like crap compared to everything, including the commodities ratio, which that commodity ratio isn't like a equal weight commodities ratio. It is mainly energy. If you put it in equal weight commodity ratio and you added the gold, the precious metals, copper, and all these other commodities that have been moving, you're probably looking at more of a really crazy downtrend in the bond market compared to commodities. And what that tells you is that inflation is sticky, and most likely inflation is coming back. I would be very surprised to be in any scenario here where inflation just kind of hangs out here for the next couple years. I think that inflation is going to be raging higher at some point, probably pretty soon. And the one thing to think about is Donald Trump. Everybody tells me that Donald Trump is the reason why oil is never going to go up again. Because they tell me this every day. Donald Trump is here. He has said that he wants gasoline under $2, and because of that, and he says drill baby drill all the time, even though we're not drilling more oil. So because of these things, the price will go down. Now, once again, he can say things and it will make the price go down in the short term. In the long term, fundamentals do matter. Trends matter. So in the long term, it's going to be a different situation. Sure, he can put some pressure on the market at points, but think about what he's actually doing. This guy wants to run it hot like no other president I have ever seen in history. He is out there going like, Fed, you guys are stupid. Lower the rates. I don't care about the inflation. Why would he say that? I mean, also, hey, guys, I think we should make 50-year mortgage rates. Hey, guys, I think we should start giving out more stimulus because of all the money I'm making on tariffs, which really with the U.S. and the amount of debt we're in, come on, that's laughable. But he says it so people believe it. the problem with things like that, it's kind of like when people say like JP Morgan is manipulating the silver market. Is there manipulation out there in every single asset class? Yes. Every single buy and sell is a manipulation. However, you can't manipulate something forever. At some point, the fundamentals or the price action or the positioning comes into play. And next thing you know, as that comes into play, we get these huge moves one way or the other. And so right now we're seeing the silver market kind of go through that. So I do think that oil is going to be one of those ones. It's kind of like a beach ball held underwater where everybody is trying to hold this thing down. You get lower, lower, lower. At some point, it's going to bounce, and the bounce could be massive, and it could be nasty, and it'll probably crush a lot of the shorts in that market. So I think that's a good way of looking at it, and not thinking too much into what Donald Trump is or isn't doing or what he's saying. Look at what he's actually doing compared to what he's saying. So here's the next chart. We're looking at gold to the yield curve. So if we're looking at gold in the yield curve currently, we're still in an environment where gold looks great. This is called a bull steepening, where we see these green arrows. Gold looks great. There's nothing to do here except for be long gold and shut up. Like, that's what I have to tell myself. I'm not telling you guys that. You guys are great, but I have to shut up and stay long my positions and not overthink this stuff. Because if I'm overthinking this, I would have gotten out of it a million times. Like, people always are like, yeah, like I'm gonna hit a top or something. Like, if you think you're gonna hit a top and you're that type of a trader, you would have sold out of this thing 100 times before it got to where it is. You would have thought there was a top at 2,200, 2,400, 2,500, 2,600. You just continued to think that. Every consolidation would have been at its top. Every pullback would have been at its top. And then also you're waiting for a perfect top, so you wouldn't even sold the thing. You'd have been like, oh, I'm going to wait for it to go up, and then maybe you try to sell it then. I mean, it's a ridiculous way to trade. The way you want to do it is understand the macro environment. Okay, the macro environment is basically saying dollars should go down. That's what a bull steepening usually is, because there's more dollars in circulation. So dollars should go down. So what should happen to gold? Well, gold should probably go up in that environment. Is it an even better environment for gold because we also have central banks buying? We also have like a really negative sentiment towards gold for a long time, to the point where people are still heavily short the miners, which blows my fucking mind every time I see that. But they're really short the mining stocks.
So the funny thing is, the shares outstanding on the GDX has been going down even as this bull market has been progressing.
That too,
Yeah.
yeah. So it's just like all these things are basically pointing to the fact that like this is gonna move a lot higher still. Has more to go. Do I know where? Hell no. I'm not even gonna try to speculate that. I'm not gonna lie to you guys and say, hey, I know that gold will end up at 10,000 or whatever the hell. I have no idea where it ends up. There's some targets in my head. They don't really matter. But at the end of the day, it's ride that trend till the end when it bends. And when it bends, be willing to get out of it at that point when it's really broken trend. Because the goal isn't to nail it perfectly. Oh, at 4,500, I'm going to sell it. Like, I don't give a shit about that. That doesn't even mean anything. What means something is I'm going to catch the meat of the move. If I'm buying this new trend on the breakout above, like, let's say it was 2,100 at that time in December 23, I think, I'm not trying to catch the perfect top. I'm trying to let that thing ride. And when it breaks trend, let's say it hits 4,500, it reverses, and then all of a sudden I see a trend break. However you quantify that, moving average crossover, 200-day moving average. It depends on your time frame or however you do it. Do it that way. 60-day lows, 100-day lows, however you do it. When it breaks that, then I'm going to sell this thing, because I'm not trying to catch it perfectly at the top or bottom. Let's say I get out at 4,000 after buying it around 2,000. I'm pretty happy with that. Not to mention the amount of leverage I'm using in futures. I'm making some good money. So think about it that way instead of thinking about it like I got to catch this thing perfectly, or is it topping today? Is it topping today? Is it topping? I could ask myself that every day about silver, and the answer is I don't know. But I do know it's in an uptrend, so I want to stay long.
So Jason, when you had your blowout cocoa trade, how much did you give back when you exited?
That would have been, because it hit the trailing stop, so it would have been around 26%. So I think
On
it
a
moved
move that was, yeah.
400%. So it moved 400% from the entry, and so it was a huge move with leverage. So it made really good money. And then the reversal, I got out, down, that 20 something percent. Once again, I'm happy. That's great. Like, once again, you can't know, especially a commodity like that, like a very small commodity, it's going to hit up and you're going to catch these crazy moves from time to time. But 400% will never be 400% at the end. It will always be something like 360, 380, something, which is totally fine. But you got to let go of that mindset where I've got to catch this thing perfectly because it'll never happen as a trader. And once you let go of that mindset, you're free to make a lot of money in these markets in a way that most people can't, because most people can't hang on to trends like that. So here's another one, and you could talk about this a little bit too, Kashop, which is GDXJ to GDX. We're looking at this to break out once again. So the junior miners are outperforming once again. I think I looked yesterday. It was like GDXJ was up something like 170%. It's getting wild out here in the precious metal space. 170% in an ETF, and GDX is up, I think, 140. So we're seeing that outperformance show up once again. Once again, more evidence of a precious metals bull market. So Kashop, going back to this one, like, what are you seeing in the junior mining space? You think it's time people get in the explorer stocks or these really junky names now? What do you think?
Absolutely. Absolutely. So I have been saying this for a long time, and the fact is, you want to be in the junkier parts of the market when one, gold is doing well and interest in gold is rising. And two, you want to be in these stocks when the financing environment gets easier. And right now, monetary policy is extremely loose and it's going to get even more loose. So this means the juniors are not going to get starved for funding. They are going to get their funding. And the reason that funding is important is the juniors, the explorers, let's make it more specific. The explorers, they don't have cash flow. They don't make money. In fact, they spend money on exploration, which means they are dependent on the kindness of the capital markets in order to survive. Now, you want these companies to raise money at higher and higher valuations so that you are not diluted as much. And that only happens when the funding environment gets looser and looser. So you want to see that, and you also want to see the underlying metal go up. For instance, let's say you're a tin explorer right now. Well, nobody cares. No one's giving you money. Whether you're a gold explorer, you're a copper explorer, people are lining up to write the checks. Now, in that environment, you should be looking at the gold explorers and the copper explorers because it's a easy way to make money. Now, of course, if you're a niche guy, then you're going to go for tin, rubidium, scandium, whatever the element catches your fancy, you're going to go for it. But in general, if you're a generalist, you should be looking for the easy trades. The gold deposit in, let's say, Arizona or Nevada, which are places that and you can sort of understand. Or if you are living in this part of the world, then gold deposit somewhere in Africa where you really understand the country, then that makes sense. So you have to look at situations like that. Now, specifically coming to GDXJ and the GDX. Now, the GDXJ has a problem. It has gotten so big and so popular, they can no longer buy the real juniors, which means they are kind of going up the market's cap scale, which means you need to start looking at the other ETFs which go lower down the scale, or you basically need to construct your own ETF. And if you do that, you're going to see more of an outperformance. Now, I'm not saying GDXJ will not outperform the GDX. I'm just saying if you want more torque to the gold price, if you want to see higher gains than what you get in these products, then you need to start thinking about building your own ETF, which goes lower down the scale. Or maybe, in a few months from now, Sprott or someone else is going to launch that. So be on the lookout for that. And when that happens, that's your cue to get in.
No, I love that because that's what we're really looking for in these markets, is really figuring out different ways to outperform, because once again, we're hunting for these outlier trades. We're hunting for these big moves that don't happen all the time. Like, this is usual. This is the S&P 500 moving up 10% a year. This is the Apple 20% a year. This is usual. What we're looking for as traders to really make really good returns. Like, if you want to make returns like the S&P 500, just put your money in the S&P 500 and take a break. It's a lot. Probably could do a lot better things with your life than looking at the market every day. Same with, you want to perform like the biggest stocks in the market. Like, once again, do that. Just put your money in Apple, Nvidia, go walk away. I wouldn't do that. I'm not suggesting that as a trading strategy, but if that's your goal, you could do it that way. For me and Kashop, we're looking for these huge moves they don't happen much. But when they happen, we take major advantage of them. So this year, for example, if we're looking at things like the gold miners, like we've been picking names, Kashop's a really good stock picker. I actually did well picking some stocks this year, so congrats for me. And that's something that I don't do very well much. Not even well, like I just don't do it. I've done it well over the years, but just don't do it much. So I've been doing a lot of that, especially in the gold mining space. Kashop helps me a lot with that sort of thing. So we're finding all these names that are making 300% moves, 500% moves, and so on. So we're making good money there. But these are the unusual moves. So these are the unusual moves, the outliers way out here. And same with the commodities. We're able to find things like palladium and platinum moving up 100% with the amount of leverage we're using on them in futures. Same thing, big moves. Even currency trades. Now, a lot of people think currency trades, oh my gosh, the dollar's only moved 10%. The amount of leverage you can get on a currency trade in futures or Forex is absolutely insane. It's crazy. So a 10% move could be something like, 100% very easily in your portfolio. That's an easy move. You can get that more to 1,000% if you really try hard. So once again, continue to look for these outlier trades. And also the other outlier this year has been international stocks. International stocks have been amazingly well. A lot of people think they can't buy internationally. However, if I said buy Spotify or something, they would all be into it. That's not a U.S. stock, but most people would buy that thing. So once again, is looking for these outliers. I don't care if it's international stocks. I don't care if it's commodities. I don't care if it's bonds. I don't care if it's currencies, crypto, whatever it is, long, short. Like that's what you're looking for as a trader, and that's how you massively outperform the broad market. Um, so that's it for slides that I have. So question wise, let's see. We got one is there any downside in using microcontracts when trading futures? Great question. Yes and no. Microcontracts are great because you can add a lot of them. Even if you're at a large size, you can add a bunch of them and scale in and out if you trade like that. But the problem is some of them are illiquid. So you have to just pay attention to which ones you're trading. If you're looking at something like, let's say, what's an illiquid one? That's the currencies. There's a lot of illiquid currency micro contracts, so be careful of those. Things like the Brazilian real is also a large contract that is pretty illiquid at times, so be careful of that. Orange juice is a liquid contract. Lumber is kind of an illiquid contract. Copper, if you had large sizes, the micro contracts are a little bit illiquid as well in copper. But oil, gold, no, those are very liquid, good contracts that you can trade that just about anybody can trade. And most of the time, it's like size wise. So if you're small size and you're buying one of these micro contracts, most of the time you're not going to get in much trouble. If you're buying like 100 of these, yeah, you could get stuck in some things. So it's more based on size and looking and understanding liquidity. If you have any questions about a specific contract, you want me to check the liquidity, just send me a message. My Substack's a good way to do that. X is a good way to do that. So I have my messenger open so you guys can send me messages on there. Hey, I'm going to trade this contract. What do you think about it? I'm not always the best at getting back to people, so feel free to hit me up more than once. But at the same time, I will get back to you as soon as I can and definitely let you know. Ironic that juice is a liquid. It sounds interesting. There's a lot of things like butter is a liquid. Uranium is very illiquid, the most illiquid. Water futures, that's probably even more ridiculous if you think about it. Water futures are completely illiquid, and the only way you could trade those is basically talking to the market maker yourself as a big utility company or something. So, just understand which ones you want to trade, but sticking to the majors, if it's gold, oil, silver, the equity futures, these are going to be very liquid. Bond futures very liquid. So that's a good place to start in when you're trading these futures contracts.
And Jason, I have a question for you. So, what are you seeing with the Japanese yen today? It's had a big move. it seems like it's going to blast right past 160. Do you have any thoughts on that?
Higher, right? The yen's
Yeah,
moving higher,
higher.
right? No, I
No,
really
it's depreciating versus the dollar or
you're
moving
looking at
higher. Yeah,
you're looking at
yeah,
USD yen.
yeah,
Okay, so I haven't looked at it, but I'll bring it up here. Let's all take a look because I'm wondering currently because I haven't looked at it lately. Um, so let's see, TrendSpider. All right, here's TrendSpider. What is the yen doing? Sorry, I got all my back testing stuff up. So USD JPY.
yeah.
So okay, so the dollar's moving up against the yen, even though the dollar has been pretty weak lately. It's interesting. Yeah, I mean, for me, it's like if we're looking at this scenario, like everybody thought now would be the time where the yen would get stronger. Like I don't think the yen has anything in it at the moment to get stronger. I think it's going to take a lot of time. The country would have to be different. I think the whether we're looking at the population sizes, population growth, birth rates, how many people even live in Japan, it just doesn't make sense that this would continue to get stronger. Like I think the dollar, even though I like the dollar, I don't like the dollar much at all right now. I do think the yen is probably even worse than the dollar currently. I think that's going to continue to happen. So I basically say keep your dollars out of yen for a while, and if that, and at some point it could happen where you're like, okay, well I want to be in the yen again. I just don't think it's happening anytime soon. What is your thoughts? I know you have a
Yeah.
lot of thoughts on the yen in Japan.
Yeah, so I kind of agree with you. That's why I wanted to get your opinion. So I think it's going to
It was after they
depreciate like
raised rates, right?
yeah,
Yeah,
yeah.
that's
But it's
interesting.
it's it's not nearly enough. They really need to make some structural change, stop fueling the carry trade, just allow it to unwind like what they tried and they failed. So they really need to do that. And the crazy thing is the Japanese people expect 11% inflation after being comfortable with zero for decades. Now, a move like this is just going to keep going. So that's my expectation. I think we are going to see 160, we are going to see 200. I really don't know where it ends. And even though it's interesting because I'm bearish on the dollar, but when you look at USD JPY, I'm forced to be bullish on the dollar. And that's just the way Forex is.
Yep. And you always have to take it relative to whatever you're trading. Like sometimes it's if you're trading against the yen and the dollar, like that's a whole different thing. Euro dollar looks very different. Let's see. I have the gold bugs index up currently. Let's get back to the normal one. Look at the euro, it's a very different story. Completely different, especially if we go out further. This is a very different story. And so we're kind of seeing this scenario here where didn't mean to do that. We're seeing a scenario here where like you don't want to be in the yen, but you want to be in the euro, which most people think like a lot of these move together. It's not that way. Some of them move in different directions, and the yen is structurally in a really terrible place, a really terrible place. So I think the euro here probably will bounce somewhere around here and probably continue higher. I think the dollar is going to continue to move lower, but I think we have to keep an open mind to what's going on in the yen and what that means for the broad equity market altogether. So, all right, guys, we're going to get out of here. Thank you guys for joining us today. This Holy Macro Show. We're usually on at 10 a.m. on Fridays. We had to move to noon today, scheduling conflict, but we try to do these every Friday with Kashop and I. Talk through the markets, go through whatever you guys want to bring up as questions. And then, at the end of it, feel free to drop us some more questions. Feel free to hit us up on Twitter. Feel free to hit us up on our platforms. Kashop has his own research platform. So do I. So definitely hit us up. Thanks for joining us. What's up, Nick? Hey, see you guys later. And we'll see you next week.
And happy holidays, everyone.